filing income tax return for the FY 21-22, which has become the filing of the return event or a lecture meeting has almost become an yearly very popular event on the BCS platform. And speaking about the BCS platform, let me take this few moments to engage you all if you have not been associated till now with the BCS or are not the members. BCS is a very unique platform and institution or an organization which works on a volunteering principle, and it's a not-for-profit organization which engages itself through the volunteers to increase and enhance the professional skills of its members and participants by holding seminars, by publishing publications on various subjects. And there have been hundreds of them over these years of almost 70 years, 75 years, which we will be completing next year. It has its journal, which if you are not subscribing, you are missing out on your professional intake, because this is one of the most widely read and respected journal in the country on this profession. So I would request you all to subscribe to this journal. If you cannot become a member because you are not a chartered accountant, it would still substitute a lot of areas of knowledge just by reading this journal. BCS also provides a great networking opportunity, and you have an access to some of the most enlightened and well-known names in the profession to directly interact, because that's the principle on which this organization works. There is no hierarchy as such, and you are free to interact, ask people who are far seniors. So you have this proliferation of knowledge going through different strata of people at their different level of experience. And this is the chance that you can get if you are a member of the BCS. Coming to the topic of today's meeting, I would say that you would have all experienced in life many times that sometimes the cause is subsumed by the effect. And this is a very classical example of this. The cause which we are discussing is the return which is necessitated for collecting the revenue by the state, by getting various information which can be collated later. And the effect of this is the administration becomes easy. Unfortunately, after 6 years, I believe 7 years of struggle, we almost took a breath which gave us a sigh of relief, which said that, all right, things are now settling down, everything is well. And there comes a bombshell which has completely subsumed the cause. This is not about income tax. Obviously, if there are laws of the land which change, the economic situation changes, the environment changes, there would be a necessity of bringing new amendments, new boxes in the returns, and the returns will change. But the issue happens when there is a mismatch of the technology which manages it and which completely overrides the return or the cause. And this is what I think everybody is experiencing today. I'm assuming that most of the people who are viewers today have at least done in the past a few income tax returns themselves, and they would have had no problems reading the instructions and going ahead with the return. But what is it that a seminar or a lecture meeting or a workshop like this with such large presence indicate that there is a certain gap, and this gap is not arising out of lack of adequate knowledge in the field of taxation, but it is out of, I would say, exasperation of not having been able to deal with this return on the technology front. So I would request both the speakers to really stress on this need to see how, if some field is not getting properly responded, what should be the action? It's people fill up the whole thing and then they say that the other is not matching, your other is not registered, or your downloading does not happen. What do you do in such circumstances? I believe those tips would go a long way, because this is what people are really feeling the brunt of. So this is my request to you. I'm not very knowledgeable on tax. I'm not into this field. So I would leave this to the experts like you. And with this, I wish you good luck. And I wish all the participants a great luck to really be able to file the returns on time now, since it is extended. And I request my colleague Anand to introduce the speakers. Thank you.
Thank you, Mirbai, for the warm welcome address. It's my honor to introduce the two young, prolific thought leaders that we have on today's session. Let me start first with the lady, Chaitee Londhe. In Chaitee, we have a practicing chartered accountant and partner with Gokhale and Sathe Chartered Accountants. And she regularly appears before income tax appellate tribunals, CIT appeals, and even the judicial forums. She's engaged in providing income tax advisory and consultancy services to various corporate, non-corporate assessees, charitable trusts, cooperative banks, and very interestingly, eminent sports association in India. She contributes articles on income tax in publication of various professional bodies and web forums, and co-authored a BCS publication on controversies relating to 56(2)(10) section of the Income Tax Act. Chaitee, to her credit, is part of the Tax Audit Quality Review Group formed under the Tax Audit Quality Review Board of ICAI. Thank you, Chaitee, for joining us for this particular discussion.
Thank you, Anand. Thank you for having me.
We have Mahesh Nayak. A lot of us on this call would know Mahesh since last many years, but as a formal introduction, Mahesh is also a chartered accountant with more than 8 years of experience in international tax, business restructuring, domestic tax, transfer pricing, and FEMA. Many of us know Mahesh as a go-to guy for any queries in relation to international tax and income tax. And Mahesh is also professionally a senior manager in the direct tax and consulting practice of CNK and Associates LLP. Mahesh, to his credit, has also completed advanced LLM in international tax from International Tax Center at Netherlands, the prestigious place as a mecca of international tax, as it is called. Mahesh is also the managing committee member and convener of the International Taxation Committee at BCS. And Mahesh has co-authored chapters on MLI Compendium of BCS and International Tax Compendium of CTC. Thank you, Mahesh, for agreeing to address and enlighten all of us on the challenges that we face in this very interesting lecture meeting. I, for one, am eagerly looking forward to Chaitee and your talk today. Thank you.
Thank you, Anand, for having me.
Over to you, Chaitee.
Yes, thank you, Anand. So I welcome all the participants, and let us start the session. I would request Mahesh to share his screen. Yeah. Okay. So is everybody able to see the screen now?
Yes, Chaitee.
So we have divided today's session into 6 main chapters, starting with changes in the due dates applicable for assessment year 21-22. Then we have covered important amendments both in Finance Act 2020 as well as Finance Act 2021 which are relevant for filing returns of income for AY 21-22. So we have mainly focused on the amendments which are relevant from the perspective of filing of returns. Then moving on, we have covered tax rates applicable for assessment year 21-22 and applicable ITRs for various classes of assessees. Then we have moved on to changes in ITR forms and ITR utilities under the new income tax filing portal. And also we have highlighted some issues that are occurring on current income tax website, as well as some issues that need to be kept in mind while filing the return of income. So going to the first chapter, which is changes in due dates. So we have recently seen that a circular number 17 of 2021 has been issued, extending various timelines applicable. Accordingly, the ITRs which were originally due to be filed before 31st July 2021 are now to be filed before 31st December 2021. The tax audits which were to be filed before 30th September are now to be filed before 15th January. The returns where tax audit or any other audit was applicable were to be filed before 31st October are now to be filed by 15th February 2022. Transfer pricing audit under section 92E, which was earlier due to be filed before 31st October 2021, is now to be filed before 31st January 2022. And accordingly, where TP audit is applicable, the returns are to be filed 1 month after the set date, which is 28th February 2022. After that, belated and revised returns for this assessment year 21-22 are now to be filed by 31st March 2022. Now, at the end of the circular number 17 of 2021, there are two clarifications given, which I've included in the slide, which say it is clarified that the extension of these dates are as referred to in clauses 9, 12, and 13 of circular number 9, which is the old circular, and as referred to in clauses 1, 4, and 5 of this circular, shall not apply to explanation 1 to section 234A of the Act in cases where the amount of tax on the total income as reduced by the amount as specified in clauses 1 to 6 of subsection 1 of that section exceeds 1 lakh rupees. So we will see section 234A and explanation there too in the next slide. Before that, let us refer to clarification number 2, which says, for the purpose of clarification 1, in case of an individual resident in India, referred to in subsection 2 of section 207 of the Act, which are individual senior citizens, the tax paid by him under section 140A within the due date without extension under circular number 9 dated 20th May and the circular provided in that Act shall be deemed to be the advance tax. So now the point to be noted here is, if you are an individual senior citizen, then even self-assessment tax paid by you will be considered without extension within the original due date will be treated as advance tax and not self-assessment tax. So let us go to the next slide. Yes, so I have given bare text of section 234A. Please refer to explanation 1, which is referred in the clarification, which says that in this section, due date means the date specified in subsection 1 of section 139 as applicable in the case of the assessee. Now, the clarification says that this extension, which is given by the circular, will not apply to this explanation 1 of 234A1, where tax on total income exceeds 1 lakh rupees after reducing only 6 items which are given in that section. So please refer to these clauses 1 to 6. Please note that self-assessment tax is not covered in these 6 clauses. So technical interpretation of this circular is that if your tax on total income exceeds rupees 1 lakh without considering your self-assessment tax, which you may have paid before filing the return, before the extended due date, you will not get a credit for that, and interest under section 234A will still continue on that. However, practically, we have experienced that this is not happening in the utility. So, for example, if your tax on total income is rupees 5 lakhs, you have paid rupees 4 lakh 50 before the original due date of filing return as per section 139(1). So now your tax outstanding is only 50,000. So if you pay that tax before date of filing return, then interest is not practically being levied. However, this is not what is appearing from the circular itself. So with that, let us move on to the next section. To begin with the amendments. So a new tax regime under section 115 BAC was introduced, which is applicable for individuals and HUFs. So I've given a comparison of the rates. So now you will notice that the slab rates have been divided, and for each slab of 2,50,000, 5% additional tax rate is applicable, going up to rupees 15 lakhs, and thereafter post 15 lakhs, tax is applicable at the rate of 30%. Okay. So while availing these reduced tax rates, certain deductions are not available under this section to individuals and HUFs opting for these new tax regime. So I've given a list of those sections which are now not available. Major exemptions and deductions which usually people avail are leave travel concession, HRA, exemption under section 1014, which are expenses incurred in performance of employment duties. However, here certain exemptions are still carved out, and exemption will continue to be available under 1014, which are cost of travel on tour or transfer of an employee, then expenses granted in connection with transfer of the employee, conveyance allowance granted to a particular employee, provided that free conveyance is not provided by the employer, and transport allowance granted to handicapped person handicapped with disability. So these exemptions will still continue under section 1014. Again, standard deduction which was available from salary is now not available under the new tax regime. 24B, so interest expenditure, which was earlier deductible under section 24B in relation to a property which was self-occupied, is now not available under the new regime. However, the deduction of 30% will still continue. Again, section 32(1)(2)A, that is additional depreciation, that is not allowed. Investment in new plant and machinery, section 32(AD), again is not allowed. Next slide, please. Uh, 57(2)A, which was in respect of deduction on family pension, 15,000 on 1/3 of the allowance, is again not available. Most importantly, deductions under chapter 6A are not available under this new regime, only except section 80CCD2 and 80JJAA. 80CCD2 is employer's contribution to a pension fund, and 80JJAA is a deduction available for generation of new employment. So these two deductions will still continue. However, rest of the deductions in the chapter 6A are not available. Secondly, carried forward loss or unabsorbed depreciation from any of the earlier assessment years, to the extent these are attributable to any of the above deductions which are not available under the new regime, will not be allowed to be carried forward and set off. Depreciation under section 32(1)(2) is also to be restricted to maximum of 40%. So for a block of asset where depreciation rate of more than 40% was allowable, will be restricted to 40%. Where as on 1st April 2020, certain allowance of depreciation has not been given full effect to, and such depreciation is pertaining to the additional depreciation then of course that is not now allowed to be carried forward. However, you can adjust the WDV of such block of asset and increase it to such extent. Next, losses under house property cannot be set off with income under any other head under this new tax regime. So basically, one may wonder that since so many deductions and exemptions are not allowed, what is the real benefit of this new tax regime? So in case of an individual who is below the age of 65 and who is earning income of 15 lakhs or above, if he does not claim any of these deductions, not a single one, still the maximum benefit that he may get on account of these reduced rate under the new tax regime will be maximum of rupees 75,000. So this is for the assessee to consider whether to opt for this new tax regime or not. Moving to the next slide. So if a particular assessee wants to opt for this new tax regime, which is provided under section 115 BAC, a person having income from business or profession needs to file form 10IE on or before the due date specified under section 139(1) for furnishing the return of income. Secondly, if a person is having income other than the income from business or profession, along with the return of income to be furnished, the option needs to be exercised. Now, Rule 21 AG, which provides the procedure for exercising this option, does not actually make any distinction between assessee who is having income from business profession and the other assessee for filing of Form 10IE. However, if you actually see on Form 10IE itself, it is mentioned that it is to be filed by a person who is having income from business or profession. Again, even in the utility provided by the income tax department, if you are an individual who is not having income from business and profession, they are not asking for the details of Form 10IE, which is not the case in the first case. So in the first case, if you are having business and profession, the utility is asking for details of such form filed. So you have to actually put in the date and acknowledgement number of this form, and then only the utility allows you to proceed further. So the section also provides that option once exercised by a person having income from business or profession for any previous year can be withdrawn only once for a previous year other than the year in which it was exercised, and thereafter the person shall never be eligible to exercise option under this section except where such person ceases to have any income from business or profession. So in case of any other assessee, the option needs to be exercised annually. The proviso to this section also provides that if any of the conditions provided in subsection 2 of this section, so the conditions are like we have seen earlier, the deductions which are not available. So if a person after exercising this option actually claims any of those deductions violating the provisions of subsection 2, then for that year he will not be eligible to claim the benefit under this new regime. If that person is having business for income from business or profession, then he gets disbarred from claiming it anytime in the future as well. So for all subsequent assessment years also, he will not be able to opt for this regime. So that was about the new tax regime. Moving on to the residential status of an. Okay, so I've just given a screenshot from the portal where, so basically, if the assessee is, having only income from salaries and other sources, it may be convenient for him if he's claiming maybe only 1 or 2 deductions under Chapter 6A. So it will be convenient for such assessees to go on the portal and utilize the calculator facility provided. So it is there under our services tab. You will have to go to the tax information tab. Next slide, please. Yes. So under the tax services, the tab of tax calculators is allowable. So here you have to select the option as to whether you are opting for 115 BAC or not, and then you will accordingly get a comparative tax rate. So moving on to residential status of an individual. So Section 6 was amended to provide that in case of a citizen of India or a person of Indian origin being outside India, coming on a visit to India having total income from other than foreign sources exceeding rupees 15 lakhs, the test of 182 days, which was there earlier, will now get converted to 120 days, provided, of course, that he has been in India for 365 days or more in 4 immediately preceding years. So if a citizen India or person of Indian origin is coming to India and his income is in excess of 15 lakh rupees, this test of whether 182 days or 120 days needs to be examined carefully. Further, such person coming to India where income from other than foreign sources exceeding 15 lakhs will be deemed to be residents in India in that previous year if is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. So person covered in the first part, whether or not his whether his income is not exceeding 50 lakhs also, if he is not resident in any other country by reason of his domicile or residence, then still he will be treated as resident of India. So those are the two amendments pertaining to residential status. So if you recall, for financial year 1920, there was a circular issued by the CBDT that for the period starting from 22nd March up to 31st March, if a person has come to India and is unable to leave on account of the lockdown, such period of stay was to be excluded for the purpose of calculating the days for the purpose of Section 6. Even in the current financial year, many representations were made to the CBDT. However, CBDT has come up with circular number 2 of 2021, and they have said that we have already considered various factors. We have considered OECD commentary, we have considered the positions taken by the other countries, and we feel that such general relaxation is not required. However, they had called in for information which was to be submitted in Form NR up to 31st March 21, asking for situations which may lead to justifying that such relaxation has to be given. However, since that timeline has already expired, CBDT has not come up with any general relaxation. Moving to the next amendment. Yes. So leave travel allowance on account of COVID situation, people were generally not able to travel and avail the leave travel allowance deduction which was available. So now this section has been amended to provide that where individual referred to in sub-rule 1 avails any cash allowance from his employer in lieu of any travel concession or assistance, the amount exempted under the second proviso to clause 5 of section 10 shall be the amount not exceeding 36,000 rupees per person for an individual and a member of his family, or 1/3 of the specified expenditure, whichever is less, subject to fulfillment of the following conditions. So first condition is that the individual has exercised an option. However, there is no actually form provided where individual is supposed to exercise this option. So practically, if the individual is claiming that in the return of income, that should be the sufficient compliance with this condition. Then it is said that payment in respect of the specified expenditure is made by the individual or any member of his family to a registered person during the specified period. Now, both the specified period registered person is defined. The payment in respect of specified expenditure is made by an account pay check drawn on a bank or account pay bank draft or use of electronic clearing system. And the last condition is individual obtains a tax invoice in respect of specified expenditure from the registered person in clause 2. So I have given on the next slide definitions of specified expenditure, which says expenditure incurred by the individual or a member of his family during specified period on goods or services which are liable to tax at an aggregate rate of 12% or above under various GST laws. Specified period is a period commencing on 12th day of October 2020 and ending on 31st day of March 21. Where an exemption under the second proviso of clause 5 of section 10 is claimed and allowed, subrule 2 shall have effect as if for the word two journeys, word one journey has been substituted. So deduction on account of LTA, which was available in respect of two journeys in a block of period, is now only restricted to one journey. Moving on to the next amendment. So under section 17(2), the limit, the threshold limit above which the contribution of the employer towards superannuation fund was set to 1,50,000 rupees. Now that limit has been extended to 7.5 lakhs in respect of contribution to a recognized provident fund, NPS, and approved superannuation fund. So if the employer's contribution exceeds 7.5 lakh rupees in aggregate, then only that excess contribution will be treated as perquisite. Similarly, the interest, dividend, or any other amount of similar nature credited to the balance of such fund or scheme, to the extent it relates to contribution in excess of such 7 lakh rupees, only will be treated as perquisite. Then the next provision is 80EEA, the deduction of interest which was available for loan granted during the period 1st April 2019 to 31st March 2020. This period has been extended now to 31st March 2021 by Finance Act 2020. So where the loan was sanctioned during financial year 1920, this deduction will be available. Of course, by Finance Act 2021, this has been further extended to 31st March 2022, and therefore it will be available in the next year as well. Moving to the next slide. So these are some of the rationalizing provisions which were long due probably. Section 43 CA has been amended to increase the tolerance limit from 5% to 10% by Finance Act 2021, which is applicable with effect from AY 21-22. Secondly, recognizing that during COVID-19 pandemic, the property values were slashed, the tolerance limit in respect of residential units transferred between a particular period, which is 12th November 2020 to 30th June 2021, this limit has been further increased to 20% to avoid the hardship on the builders. The condition is that it has to be the first time allotment and the consideration does not exceed 2 crore rupees. Frankly speaking, one wonders what is the logic of such condition, because if property prices were slashed during this period, even if the total consideration is in excess of 2 crore rupees, it should have been, in my view, equally applied to. However, this has not been done. And there is a condition that total consideration should not exceed 2 crore rupees. Similarly, under section 56 to 10, tolerance limit is increased from 5% to 10% generally in respect of immovable properties. In respect of residential units transferred between this period, it is increased to 20%. Now, one thing to be noted here is that the condition of first time allotment is also applicable to section 56 to 10. In case of 43 CA, of course, it will mostly be first time allotment because the section is applicable to builders. But 56 to 10 is applicable in respect of both capital asset and other assets. So wherever the property is purchased from a builder, it will generally be a first time allotment. However, where the property is purchased from third party buyer who holds it as a capital asset, then this increased tolerance limit is not available in such case. So this is something to be noted. Under section 50C, general tolerance limit is increased from 5% to 10%. However, this second condition is not there in respect of transfer of residential unit, and 50C does not contain such increased tolerance limit. Moving on to the next slide.
Yeah, thanks, Chaitee.
Yeah.
So I'll be taking some of the other amendments that have been enacted by the Finance Act 2020 as well as Finance Act 2021, which would be applicable for filing the returns for assessment year 21-22. One of the major amendments which took place by Finance Act 2020 was the abolishment of the DDT regime, where now we have gone back to taxing dividends as income in the hands of the shareholder. So from which dividend which is declared and paid on or after 1st April 2020 would now be taxed in the hands of the shareholder, and DDT would not apply on such dividends. Similarly, income from mutual funds, which were again subject to a distribution tax earlier, are now going to be taxed in the hands of the unit holders. So this is an important amendment that needs to be kept in mind. Some of the sections which have been amended are section 1150, which talks about the DDT, the dividend distribution tax, or 115R, which talks about which refers to income from mutual funds. We also had a provision of section 115 BBDA, which was introduced a few years back, where dividend received by resident individuals and HUF, which were over 10 lakhs, but taxed in the hands of the recipients, even after the dividend had suffered DDT. Now that, with going back to the classical regime of dividend taxation, 115 BBDA also has become inapplicable. We had exemptions under section 1034 and 1035, which provided exemption for dividend income received by shareholder, dividend income, as well as income from mutual funds received by shareholders and unit holders. Now that where the dividend had been subject to DDT, now that again is no longer applicable. We have provisions on the TDS in respect of dividends under section 194 for residents and 195 for non-residents. Similarly, for income from mutual funds, we have TDS provisions under section 194K. Similar to in section 1150 in the DDT regime, there was a provision of which provided a pass-through, sort of a tax in a scenario where the company which had received the dividend was on paying the dividend to its shareholders. Similarly, you have the provisions of section 80M, which provides a deduction in the hands of the domestic companies for intercorporate dividends. These dividends would be taxed under income from other sources. So you have deduction under section 57, where interest expenditure is permitted. However, that interest expenditure is capped at 20% of the dividend or income from mutual funds, as the case may be. So what are the rates that will be applicable in the hands of the recipient shareholders or unit holders? In case of resident, it will be at the applicable rate. However, the surcharge on the dividend cannot exceed 15%. For non-residents, you have 20% plus applicable surcharge and education cess, or the rate as per the tax treaty, whichever is more beneficial, subject to tax treaty entitlement. Now, what are some of the points that need to be noted in respect of dividends? One is, dividend is going to be taxed as income from other sources. So your deduction of interest should be restricted to 20% under section 57 to 20% of the dividend income or income from mutual funds. The other aspect is, now there will be very few investments which would now be subject to, where if you have investments in those certain assets, where expenditure could be disallowed under section 14A. So therefore, one may possibly see, unless there are those interest-free bonds or, income, say, investment in a partnership firm. Otherwise, the provisions of Section 14A may not apply in most of the cases, now with dividends being taxed in the hands of the shareholders. Uh, Finance Act 2021 provided an amendment to Section 234C with effect from assessment year 21-22, which provides that similar to capital gains, when one is computing advance tax, the income from capital gains is to be considered from the quarter in which you have received those gains, and one does not need to estimate the capital gains for the year, unlike the other income. Similarly for dividends as well, because a shareholder does not know when how much dividend will be received and when it will be received from the companies or from the mutual funds, and therefore one need not estimate the dividend income. And Section 234C has been amended to provide that for in case of dividend income, Section 234 interest under Section 234C will not apply if you have provided for the dividend income in your advance tax computation from the quarter in which you have received the dividends. Another important this thing is that there is a difference between dividends. While under the Income Tax Act they are treated almost on a similar footing, there's a difference between dividends and income from mutual funds. So therefore, now when one is looking at say filing the returns for non-residents, at applying the treaty, the income from mutual funds may not be subject to the same tax, or may not be covered under the same article of the tax treaty as income from mutual funds, because dividend is something that is paid by a company, whereas it may not income from mutual funds may not necessarily fall under the definition of dividend. So one will need to look into that as well. What happens to there has been an amendment, consequential amendment, even in REITs and InvITs, because of this amendment in the dividend taxation regime. So earlier under the erstwhile regime, dividend paid by the SPV to a REIT or InvIT or business trust was not subject to DDT. Similarly, when the income was distributed by the REIT or InvIT to the investor, it was exempt under Section 1023 FT. So therefore, there was effectively a pass-through, complete pass-through status that was given to the investor. Now that has been amended slightly. Dividend paid by an SPV to a REIT InvIT, being a shareholder, would now get an exemption under Section 1023C, subclause B. So therefore, such dividend would be exempt in the hands of the REIT or InvIT. When the REIT or InvIT distributes the dividend to the shareholder, to the investor, sorry, at that time, one needs to see whether the SPV has opted to be taxed under the new regime of Section 115BAA or not. If the SPV has opted to be taxed under Section 115BAA, then the dividend would be taxed in the hands of the investor. So it will be a pass-through tax that would be given. However, if if the SPV has not opted to be taxed under 115BAA, then there would be an exemption. So therefore, there would be no tax. So what would typically happen is what was under the erstwhile regime, where once the SPV has paid tax on its profits, there is no tax in the income that is earned by the unit holder through the REIT or InvIT. That would continue if provided that the SPV has not opted to be taxed under the Section 115BAA. Typically, on the website of the REIT, one would have the declaration from the REIT or InvIT whether they have opted to be whether the SPV has opted to be taxed under 115BAA or not. So therefore, one would come to know from there. Let us look at another amendment, which is an important amendment. Now, this is an amendment which has happened in Finance Act 2021, but it applies from 1st of April 21, that is applies from assessment year 21-22, and therefore one may need to look into whether this may apply for transactions which have already happened during the year. There are a few amendments of such nature, also which we will be discussing subsequently as well, which have been enacted only in the Finance Act 2021, but apply to assessment year 21-22. So the first amendment we talk about Section 9B and 45(4). So section 9B, a lot of us would have read a lot about it. Section 9B basically deems the capital asset to, in case of a dissolution or reconstitution of a partnership firm, AOP or BOI, when a member or a partner receives any capital asset or a stock in trade, then such asset is deemed to be transferred in the year in which such partner or member has received it. So it, in the past year, we have had a lot of plethora of decisions which have held that any transfer from the partnership firm to to its partner is not income, or there is no transfer because the partner is only getting what he already had a share in. However, now section 9B deems such income to be capital gains, and it would be taxed accordingly. Now, for the purpose of determination of capital gains, it provides that the fair market value shall be considered as the consideration, fair market value of the capital asset or stock in trade that is distributed to the partner or member, that will be considered as the consideration for the purpose of computation of capital gain. Now, reconstitution has been defined as to mean where one or more of its partners ceases to be members or partner, that is a retirement of a partner, or where one or more members are admitted such that one of the erstwhile partners or members continues. So you're talking about admission of a partner, or where in situations where all the partners or members continue with a change in their respective shares, that would also be considered as a reconstitution. What also happens is you have section 45(4), which works independently of section 9B, which provides for taxing the firm, AOP or BOI on the difference between the capital asset transferred and the capital account balance of the receiving partner on reconstitution. Now there, the capital gains is so basically it is the consideration, the capital gains is taxed in the hands of the firm, AOP or BOI. The method of computation of capital gains is the value of money received by the partner as increased by the fair market value of any capital asset received by the partner, as reduced by the capital account balance of the partner or member in the partnership firm, AOP or BOI. Ignoring the if there is any revaluation of asset or goodwill that has been given effect to for the capital account balance. Now the question, so effectively what section 45(4) does is where for example on retirement of a partner, when there is a distribution of the capital asset, so firstly, under section 9B, the distribution of the capital asset, let's take a scenario where a land or building, a land is given to by the partnership firm to the partner. So under section 9B, the land would have been deemed to be transferred, and the difference between the fair market value of the land and the cost of acquisition of the land in the hands of the partnership firm, which can be increased to the index cost if it's a long-term capital asset, would be taxed under section 9B. Under section 45(4), one would look at the value of the land and to the extent it is in excess of the capital account balance of the partner, then so let's assume if the land, the fair value of the land is say 100 and the capital account balance of the partner is say 10, so 90 is what would be taxed in the hands of the partnership firm. Ideally it would have been taxed in the hands of the partner, but then it is the partnership firm which is liable to tax. Now the question is, in such a scenario, now assuming, so we have all firstly, it is applicable for assessment year 21-22. Now in a normal scenario you would say, okay, in such a scenario, what is the period of holding? Is it a long-term capital asset? Is it a short-term capital asset? Under section 45(4). For section 9B, one looks at what is the period of holding of the capital asset that is transferred. For section 45(4), the question is whether one needs to look at does one look at the date from which the partner has been a partner in the partnership firm, for example, or from the date on which he has contributed the capital. Now that that would have been an ideal scenario, but we have rule 8AA, which has been introduced in the month of July 2021, which provides you have rule 8A. The rule 8AA was already there, but there has been an amendment where subclause 5 has been added from July 2021, and it provides that the capital gains shall be to the extent it is attributable to a short-term capital asset or a capital asset which is forming a part of block of assets, or to the extent of goodwill, it will be considered as a short-term capital gain. To the extent it is attributable to a long-term capital asset, then it will be considered as a long-term capital gains. So therefore, effectively, it divides the gains into seeing that that gain is arising from what? Is it arising from a revaluation of your block of assets or any other asset of your investments? And accordingly, the gains would be short-term or long-term. Now, this has come in from July 2021. Now, the question arises, and now it's a well-settled position that the rules which are applicable on the first day of the assessment year is what would apply. Now, in this particular scenario, the question is, can one apply rule 8AA, or would one consider that in a normal provision, one would look at the period of holding from when the partner was a partner in the partnership firm? There are a lot of other nuances of section 45(4). I believe and I understand that BCAS, the Direct Tax Committee, has already organized a workshop in the month of October, specifically on partnership firm section 9B and 45(4). I'm sure, I think it will be an interesting workshop where a lot of these nuances would be considered. Similarly, section 48(3) has also been amended, where that because of section 45(4), any gains that is attributed to 45(4) or any gains that is arising in 45(4) can be attributable to capital assets in the manner that may be prescribed. Now, again, rule 8AB was introduced only in the month of July 2021, and that provides the manner in which such attribution is to be undertaken. And it provides that if the entire gains under section 45(4) is on account of revaluation of an asset which has already been transferred to the retiring partner or to the receiving partner rather, then there will be no adjustment. However, if it is attributable to any other capital asset which is continuing with the firm, then it will be attributed, and one would need to compute and allocate it on the basis of the increase in the valuation of each individual asset, and the balance would be considered as goodwill. Now, what would happen is when that asset is sold. So let's assume that this is in the the 45(4) is the revaluation is also in respect of another asset, say land or building, which is not which is revalued but which is not transferred to the partner. In such a scenario, the value of that building, let's say building, would be increased. When that building is sold, then consideration of that building, of sale of that building, would be reduced in respect of the tax that is attributable to that asset. Now, this section 48(3) provides that consideration received on sale of the capital asset eventually when it will be sold will be reduced by the amount of capital gains tax that is taxed under section 45(4) to the extent attributed to that capital asset which is transferred. However, this amendment is only in section 48, and there is no consequential or there is no similar amendment in section 43(6), which refers to your WDV. So therefore, the question arises is whether such a in a scenario where the block of asset does not cease to exist. So let's take a scenario where there's a building which is where you have attributed certain value of the capital asset under section 48(3), or which would have been, but that building has been transferred and the block does not cease to exist. Then what happens? So there's no consequential amendment to section 43(6), but in July 2021, when rule 8AB was introduced, there was also a guidance that was given and that guidance provides that whatever amendment is there in section 48.3, it is deemed to also have been taken place in section 43.6 to the extent. And therefore, when, if and when the building has been sold and whatever consideration has to be reduced from the block, that consideration would be first reduced. It would be a reduced consideration, and from the consideration, you would first remove the extent of the capital gains tax, which is attributable under section 45.4. There is a form 5C which needs to be filled by the firm, AOP or BOI, which specifically providing the allocation of the capital gains, the increase in the value of the capital assets, or allocation of increase in the value of capital assets on account of the tax payable under section 45.4. This needs to be in the year in which the tax under section 45.4 is applicable, and it needs to be filed before the due date of the filing of the return. Now we have seen Chaitee had explained that we had the optional tax regime under section 115 BAC for individuals. There is also a optional tax regime for cooperative societies, which provides for a tax rate of 22% plus 10% surcharge and 4% cess, which is effectively 25.17. Cooperative societies today are taxable under, there is a special slab rates that are applicable to them. However, and if one sees that it is the provisions or the deduction that one needs to forego to opt for this new regime are similar in the case of 115 BAC. So you have your 33 AC, etc. Additional depreciation. Interestingly, deduction under section 80P will no longer be available if you opt for the new regime. So if you have interest, say from another cooperative society, or those typical the specific societies which have earning business income, etc., that deduction which is eligible for section 80P deduction will no longer be there if you opt for the new regime. 80JJAA, 80LA would be available. Other deductions under chapter 6A or any losses, etc., which are arising out of this additional depreciation, etc., would not be available if you opt for the new regime. Similarly, the alternate minimum tax under section 115 JC would also not be applicable if you opt for the new regime. So typically, if you're a cooperative society and assuming that there is no deduction under section 80P, then typically approximately if you have about 51,000 of income, then it is sort of even between both the old and the new regime. However, as the income increases, the new regime may become more beneficial. However, one needs to do a proper analysis of what is the future outlook, etc. Because once this option has been selected, then it shall apply for subsequent years as well. It cannot be withdrawn. Another interesting amendment which has taken place in Finance Act 2021 and which has an impact in assessment year 21-22 is that of depreciation on goodwill. Now, as we know, we had the Supreme Court judgment in the case of Smith Securities, etc., which had held that goodwill arising out of a merger or of a transaction, slum sale, etc. Now there are various other judgments as well. The difference between the assets acquired and the consideration paid would be considered as goodwill, and goodwill would be considered as a depreciable intangible asset, and therefore one would be able to claim depreciation on that. Now, from Finance Act 2021, but with effect from assessment year 21-22, it has been provided that goodwill will no longer be a depreciable asset. Now, this has had a major impact on a lot of companies or assessees where there has been a transaction in the last few years, because the question is, what about interest under section 234C? Because people would have already, because this amendment only came or was only announced firstly in the Finance Act, Finance Bill in on 1st Feb 2021. So before that, no one had any clues. So the first 3 installments of advance tax would have already been paid. So what about interest under section 234C? Will it be considered as will it be leviable, or can one defend such interest levy on the ground that this is a retrospective amendment in the sense that the transaction has already taken place and therefore and the tax law has been changed after that. So there is a Gujarat High Court decision also in the case of National Dairy Development Board, and there are a few other decisions which have held that because of a retrospective amendment, arguably interest under section 234C shall not apply. Now, goodwill is to be reduced from the WDV in the manner in which it is prescribed under section 43(6)(c). Basically, what section 43(6)(c) says is that goodwill is first out of the block. You assume that goodwill was the only asset and you depreciate it up till assessment year 2021, and then that WDV of that goodwill, as if it was the only asset, that is what is to be removed from the block of assets. If there is a negative amount, obviously, then the block of assets will be considered as 0 for section 43(6) purposes. Now, the question is, if after removing this goodwill, there is a negative amount, or in the sense that the amount of goodwill that has been removed is higher than the WDV of the block of assets, and assuming that there is, because this would typically be in a scenario when one has other intangible assets in the block as well. So let's say, for example, trademark. Then what happens? And we have an example of that, of what will be the impact, because you have Rule 8AC, which again has come from 7th of April 2021, which provides for computation mechanism of capital gains arising in case of such a scenario where the goodwill, the amount removed from the block of asset exceeds the WDV of that particular block, specifically because of this goodwill adjustment. So let's take an example. Let's assume that in assessment year 17-18, one had acquired 2 trademarks for 200 and claimed depreciation at the rate of 25%. Let's assume that assessment year 18-19, one acquired a business because of which there was goodwill, and therefore there was an addition of 500. Now, let us further assume that in assessment year 19-20, out of the 2 trademarks which were acquired, one of the trademarks was sold, and that was sold for a significant profit. However, because at that time, neither the block ceased to exist because there were still assets, nor did the consideration received for sale of the trademark 1TM1 exceed the WDV. Therefore, the block continued to exist, and therefore one continued claiming depreciation. Now, assessment year 21-22, one has to remove the goodwill. So therefore, on 500 of goodwill, one computes depreciation for assessment year 18-19, 19-20, and 20-21. And the WDV works out to approximately 211. Now that 211 has to be removed from the block of assets under section 43(6) as amended by Finance Act 2021. Having removed this, one would see that the block would then otherwise become negative. So the question is would this lead to a capital gains? What Rule 8AC? So Rule 8AC provides, so first let's understand what is section 50, because section 50 refers to a similar provision where the block ceases to exist because the consideration exceeds the amount that is of the block of opening WDV. So section 50 subclause 2, there's a proviso. So section 50 subclause 2 provides that what happens where a block of assets ceases to exist for the reason that all the assets in the block have been transferred. So the proviso to subclause 2 of section 50 provides that in a case where goodwill of a business or profession forms part of a block of asset for the assessment year beginning on the first day of April 2020, and depreciation thereon has been obtained by the assessee under the Act, the written down value of the block of asset and short-term capital gain, if any, shall be determined in such manner as may be prescribed. So, and following this, Rule 8AC has been provided in, has come in the month of July. Now, the question here is whether this proviso has to be read in the context of section 52, because section 52 talks about that the block of assets ceases to exist for the reason that all the assets in that block are transferred during the previous year. In this particular scenario, the goodwill is not transferred, the goodwill still is with the taxpayer. It is only because of section 43(6), which asks you to remove the goodwill from the block. That is why it is there. So therefore, there's no transfer. However, I think the courts may read down this because that the intention of the section again is to provide, possibly it may be considered as a an error in the drafting, and it may actually not be a proviso necessary to section 52, but to section 50 itself. And therefore, the proviso may still hold good. Now, the question is, what about the rule which came in July? So it was not applicable on the 1st of April 2021. So first, let's see what the rule says. The rule says, Rule 8AC sub first, let's understand what Rule 8AC subclause 4 says. Rule 8AC subclause 4 says that where goodwill was the only asset in the block for which depreciation was obtained by the assessee in the assessment year beginning 1st April 2020, and the block ceases to exist on account of there being no further asset acquired during the previous year relevant to assessment, basically during assessment year 21-22 in that block, there will be no capital gains. So if goodwill was the only asset on 1st April 2020, so in this particular example, if in assessment year 1920, the assessee would have sold both the trademarks and goodwill was effectively only the only asset standing in the block, then there would be no capital gains. However, because this is not the case here, because one has another trademark or another asset in the block, one needs to read subclause 3, where what subclause 3 says is where the reduction under section 43(6) for the previous year assessment, for the assessment year 2021-22 exceeds the aggregate of the written down value of the block of assets as on 1st April 2021 without giving effect to this reduction, which is 133, and the actual cost of asset falling under the block which has been acquired during assessment year 2022, which is nil in this case. There's no addition in assessment 21-22. Such excess shall be deemed to be the capital gains arising from the transfer of short-term capital assets. So this rule is specifically only for assessment year 21-22. And therefore, while for the other provisions, one may be able to take a position, possibly one may be able to argue, while it may be subject to litigation, that that as the rule was not notified as on the first day of April 21, that rule should not be applicable, given that this rule, because the removal of goodwill from the block of assets will only happen in assessment year 21-22, because going forward, goodwill cannot enter the block. So therefore, given that this rule is possibly only applicable for assessment year 21-22, possibly the courts may read down that requirement of it being applicable from only on the first day of the assessment year. But therefore, one may need to look at. So therefore, what one needs to do, two things, is for in respect of goodwill, one needs to see whether there are any other intangible assets, because if goodwill was the only asset in the block right from day one, then there would have been no issue, because if no other intangible asset entered the block, then there would have been no issue, because the goodwill only would have been, so the deduction under the reduction under section 43(6) would be equal to the WDV in that case in any way. But if there was any other intangible assets, then one needs to see if it would result in short-term capital gains under section 50. Now we move on to some other amendments. Section 36(1)(5)(a), so employee delay in deposit of employees' contribution to provident fund. This has been subject to litigation for the past few years, where there are multiple High Court judgments which are in favor. So notably, you have your Kharge Patil and Hindustan Organics, the Bombay High Court, which is in favor of the assessee, saying that as long as the employee's contribution to provident fund is deposited within the due date under section 43(b), one would be able to claim a deduction of the same. Now, typically what was happening is there was also a CBDT circular in 2015, which provided that the basis of these Bombay High Court judgments is the alum exclusion Supreme Court judgment. So the CBDT circular provided, or CBDT circular 2015 provided that the department was of the view that the alum exclusion judgment does not apply to employees' contribution to provident fund, and therefore 43(b) would still not apply. And if there is any delay even of 1 day in deposit of employees' contribution to provident fund on a monthly basis, then that delay would be considered, that contribution would be considered as income of the assessee under section 36, and there would be no deduction that would be available. Now, that it will be considered as income under section 224, sorry, and the reduction under 36 would not apply. Now, typically, and I think most taxpayers would have faced this as that, because in your tax audit report, you would typically disclose the due dates of the dates of the payment along with the due date. So if there was any delay, it would automatically be picked up. If you did not offer any addition on account of this delay, typically you would get notices under section 143(1) on this, and in the past, and there has that is there. Now, Finance Act 2021 has amended the provision and to provide, with effect from assessment year 21-22, to provide that any delay in deposit of employees' contribution to provident fund was never meant to be covered under section 43B. So therefore, now assessment year 21-22 going forward, if there is any delay in deposit of employees' contribution to provident fund, such such contribution for that month would need to be added to the income. Similarly, then another provision was you have your section 44 ADA, which is in respect of presumptive taxation from professions. Now, 44 ADA, the provision earlier did not provide it was applicable to partnership firms as well. The section did not say it does not apply to LLPs. Interestingly, the ITR form earlier, so I've given a screenshot of the ITR form for last year, ITR 5, where while the section was silent, 44 ADA was applicable to partnership firm, and LLP is also considered a partnership firm under the Act. But while the section was silent, the ITR provided that the 44 ADA would not apply to LLP. And this is similar to what 44 AD, while section 44 AD clearly always provided that partnership 44 AD applied only to partnership firms other than LLP, whereas 44 AD did not provide that. However, the ITR did cover this in the past as well. Now that has been enacted, so 44 ADA now applies to partnership firms which are other than LLP. There are a couple of other amendments in respect of in respect of section 94B, which may not have too much of a consequence. We'll just cover that for a holistic approach. So you have your 94B disallowance for excess interest that is paid to beyond 30% of your EBITDA that is paid to your associated enterprise. Now, the disallowance under section, so the amendment provides that the disallowance under section 94B by Finance Act 2020, that the disallowance under section 94B shall not apply to interest that is paid where the lender is a banking company and has a PE in India. Now, this may not have much of an impact because 94B only applies to payment to associated enterprise. So typically where a bank has a permanent establishment as well as an associated enterprise in India, and the associated enterprise has taken a loan from the PE of the entity, only of the bank, only then would this amendment apply. Similarly, another amendment is in respect of in the provisions of MAT under section 115JB, in the reductions in respect of capital gains, royalty, FTS, and interest. In case of a foreign company, it provided that the one would reduce the income from these particular sources of income if the rate under the Act was lower than the MAT rate. Now, that with earlier dividend was exempt because it was subject to DDT. Now with the amendment, it would now DDT would be dividend would be taxed in the hands of the recipient. Now, therefore, dividend 115JB has been amended to provide that dividend earned by a foreign company would not be subject to MAT if the rate of tax on dividend is lower than in the Act in the MAT rate. Now, this may not really apply because under section 115A, the rate of dividend is 20% vis-a-vis the MAT rate of 15%, except in case of dividend from GDR or CAT3 AIF, which is located in IFSC. Very quickly, keeping track of the time, very quickly, just briefly running through section 80IC. There has been amendment where the period deduction, the period for which deduction is allowed has been extended to 3 out of 10 years instead of 3 out of 7, and an eligible entity can be set up even up to 31st March 2022. And more importantly, the turnover threshold has been exceeded, has been increased from 25 to 100 crores. Similarly, for section 80IBA, there's been an extension for the project to be approved by the competent authority, which was earlier before 31st March 20, before 1st April 2020. Now it is before 1st April 2021. Under section 115BA and 115BAB for assessment year 2021, deductions under chapter 6A part C were not allowed except 80JJAA. From assessment year 21-22, now that has been amended to say no deduction under chapter 6A shall be allowed. So typically your 80G deductions or your deduction under 80JJAA or GGB, which a company could have claimed even after opting for 115BA in assessment year 2021, will no longer be available for assessment year 21-22. Another important amendment is the turnover threshold for tax audit has increased from 5 crores to 10 crores. Then the slum sale has been made taxable, slum exchange has been made taxable, and similarly for slum sale also the computation of fair market value has been amended. So we will not go through these because these are the new slab rates and there are not too many changes in the slab rates. I think BCS can circulate the slides and this is pretty much self-explanatory there. Chaitee, you want to quickly take the changes in the ITR forms?
Yeah, yes, Mahesh, thank you. So we can quickly see the applicability of various ITRs to various assessees. So basically, there is no. Can we please go to the next slide? Yes. So the only change in the applicability ITR of ITRs is here in ITR 1, where so individual who is either a director in a company or invested in unlisted equity shares was already there, carved out from the applicability of ITR 1. In addition to that, now cases where TDS has been deducted under section 194N, or if income tax is deferred on ESOP, is also covered under this exception. So in both these cases, ITR 1 will not be available, ITR 2 will be available. So just to give a quick brief, 194N is TDS on withdrawal of cash in excess of 1 crore rupees. And so by Finance Act 2020, taxability on employee stock options were deferred to a point of time being earlier of either 48 months from the relevant assessment year, or sale of the ESOP by that employee, or the date of assessee ceasing to be employee of that particular employer. So whichever is earlier, till that point, taxability of ESOP has been deferred by Finance Act 2020. So that case has been removed as an exception from ITR 1 and it will get covered by ITR 2. The rest of the criteria remain the same as of last year. So we can just skip through this. Okay, so applicability, as I mentioned, these two cases have been specifically excluded here. In part A, general information, a new field has been introduced where assessee has to select whether 115 BAC has been opted for or not. As I mentioned earlier, for individuals not having income from business or profession, this is the only requirement. So this option yes or no has to be carefully selected because there is no requirement to file form 10 IE in those cases. Then in schedule OS, in case of dividend income, assessee is required to mention quarterly breakup of allowing applicable relief from 234C, where there is a shortfall in advance tax paid. So from financial year 21-22 onwards, there has been an amendment in reporting requirements for SFT, that is specified financial transactions. So there now dividend paying companies are also required to report the dividend giving a quarterly breakup. So from next year onwards, probably that will get auto reconciled by CPC. But for now, this breakup has to be mentioned by the assessee while filing ITR1. Schedule DI, which required two clauses, that is eligible amount for deduction during financial year 1920 under Chapter 6A, and reduction attributable to investment or expenditure made under various sections of Chapter 6A, made between 1st April 2020 and 30th June 2020. So these two clauses were already there under Schedule DI in Form 1 and 4. But now this Schedule DI has been removed because this extension for making investment or expenditure which was relevant for Chapter 6A deduction is not there. So therefore, consequently, this schedule has been removed from ITR 1 and 4, and the details have to be provided under Chapter 6A. Going to ITR 2. Again, this is the same option, whether 115 BAC has been opted for or not. Second change is there in Schedule CG, where variation of 1.05 times is increased to 1.10 times in accordance with the increased in tolerance limit under Section 50C. Going to Schedule OS, which is income from other sources, gross dividend has to be declared under Section 1034 and 1035, which were earlier exempt. Further, wherever the interest is deductible, that deduction is restricted under Section 57(1), and therefore the breakup of gross and such the expense of interest so claimed has to be given under Schedule OS. Disclosure of dividend taxable under Section 115 BBDA is omitted. 115 BBDA was applicable where dividend was otherwise exempt, but dividend in excess of rupees 1 lakh was taxable at the rate of 10%. So consequent to dividend becoming taxable, this disclosure has been removed. Disclosure of interest income chargeable under Section 115A at the rate of 4% is added. So 115A1 subclause A deals with interest on masala bonds, that is rupee denominated bonds, on which TDS rate of 4% is applicable. So this is only a disclosure requirement. Similarly, dividend referred to in Section 114 LBA, which is subject to withholding tax of 5%, is to be now disclosed separately under Schedule OS. Then Schedule SI, which pertain to 115 BBDA, is now omitted. Under Schedule PTI dividend, the reference to Section 1150, which was tax on distributed dividends, has been removed consequently, as on account of changes in taxation of dividends, as explained by Mahesh. Under Part B, Schedule of Total Income, tax on ESOPs received from eligible startup which is deferred has to be disclosed separately. Again, this is only a disclosure requirement. Tax on income apart from the aforesaid perquisite is to be declared separately, and bifurcation of surcharge before and after marginal relief is to be disclosed. So these are basically disclosure requirements where gross amount is to be bifurcated into two. Under Schedule TDS, a note has been added which says that only if corresponding income is being offered to tax this year, not applicable if TDS is deducted under Section 194N. So under TDS schedule, there is a provision to carry forward the TDS credit which is appearing in your 26AS currently. But if you have not offered the corresponding income to tax in this year and that is to be offered in the next year, then such credit can be carried forward to the next year. However, this will not be applicable to TDS deducted under Section 194N, which is deduction on cash withdrawal in excess of rupees 1 crore. So under ITR 7, again, 115A, which pertains to interest on which tax is deductible under Section 4. and dividend, which are subject to tax at the rate of 5. So similar disclosure as we have seen earlier is to be given here. Again, reference to 115 BBDA has been removed. Reference, similar note on TDS is to be given. So just like we have seen in the earlier form. So now I would request Mahesh to cover the other
Yeah, so
idea.
just quickly covering, what are the changes in the other ITRs. In respect of ITR 3, again, you have a new field to determine if 115 BAC has been opted for by the taxpayer, and you're required to give the acknowledgement number of the Form 10IE that has been filed. In Schedule 5A, there's a drop down on whether the books of the spouse under the Portuguese, which is governed under the Portuguese Civil Code, are required to be audited under Section 44AB, or whether transfer pricing applicable, because then there's a change in the due date as well. Because even for a spouse which is governed under the Portuguese Civil Code, where the other spouse is subject to tax audit or is subject to transfer pricing, then the due date that is applicable to that spouse would also apply, in this similar manner. Another amendment is in respect of scheduled DPM, depreciation on plant and machinery, where the amount has to be adjusted if you're opting to be taxed under Section 115 BAC, in case there is any additional depreciation, etc. So that adjustment needs to be taken, that is to be provided in Schedule DPM. Similarly, even for Schedule CFL and Schedule UD, carry forward losses and unabsorbed depreciation, in case any loss is on account of the deductions which are you are no longer eligible to claim, or if you opted for Section 115 BAC, then that adjustment that needs to be made. Other changes have already been covered by Chaitee. So your Schedule OS in respect of dividends, OS, DI, SI, or capital gains, or your marginal relief in Part B, TTI, etc., has already been covered. In ITR 5, again, similar to 115 BAC, for cooperative societies, if you're opting to be taxed under Section 115 BAD, that option is available, and you need to select whether you opted for it or not. And if you have, then details of Form 10IF need to be provided. Again, Schedule DPM, depreciation schedule, carry forward loss and unabsorbed depreciation in respect of BAD to the extent of deduction or depreciation which is no longer available because you opted for the new regime, that adjustment needs to be made. So that a specific row has been provided for that. Interestingly, for 80GGAA, that is donations for scientific research or rural development, the date of donation that needs to be provided in ITR 5. No such date, etc., is required to be provided in for Schedule 80G, but for Schedule 80GGAA, one needs to provide the date of donation. Moving on to ITR 6, Schedule DDT has been removed because the DDT regime no longer applies, and the details of the dividend paid and deduction under Section 80M is provided, has been added as in Schedule 6A. The other amendments, again, in respect of your dividends, Schedule OS or capital gains or DI, Part B, TTI, or pass-through income and TDS would continue. Just very quickly, I think in the interest of time, there are quite a few issues with the portal, and one hopes that because one hears of a lot of issues where there are multiple entries that are reflecting in the pre-filled data, or Form 26AS is not being imported in the pre-filled data, or there is generation of multiple acknowledgements or excess refunds, or no rectification tab, etc. is there. So one hopes, as time goes, these issues will be sorted out. We know that the deadline given by the government was today, but there are still certain issues that are there. So hopefully in the coming days, these issues hopefully should be resolved. Which forms have been, the utilities have been released. So ITR 1, 2, 3, 4, the JSON utility has been released. So for ITR 5, there's an Excel utility that has been released. ITR 7, again, JSON utility was recently released. ITR 6, while the form, etc., has been notified, the utility has not yet come. For the DSE management utility, there is a utility Embridge that needs to be downloaded and that needs to be used. So earlier, the signature file, etc., which was being used, that process would no longer apply. One needs to utilize this DSE Embridge utility management utility. Just quickly, some of the points that need to be kept in mind while filling the ITRs for assessment year 21-22. Your interest under section 234A. So while the due dates, etc., have been extended, if there is any tax payable, then there would be there is any self-assessment tax payable, then there would be interest under section 234A. Another important issue to be kept in mind, and I think a lot of us would have got notices, etc., is that there is a lot of data integration from various authorities and from various financial institutions, etc. There is a lot of reporting requirements and there's a lot of reconciliation, etc., of this data. So one needs to keep in mind that all the possible relevant data has been disclosed, and no specific item of income, etc., has been missed out. Another important point is to keep in mind is that from this year, dividend income and income from mutual fund is included as income of the assessee, which was exempt earlier. Similarly, one needs to look at, because this income is taxable, review whether disallowance under section 14A is warranted or not. And lastly, another important thing to keep in mind is that for deduction under chapter 6A and other deductions, where the extension was given for assessment year 2021 up till June, where such investment or payments have been made and the deduction for the same has been claimed in assessment year 2021, ensure that that same deduction is not again claimed for assessment year 21-22. On this short note, thank you for a patient hearing. And I know we have gone ahead of time a little bit. And yeah, thank you so much.
Divya, you go ahead with the vote of thanks.
Yes, Mihir Bhai, thank you very much. Good evening, everyone. We have announcement from BCS for the two upcoming tax events. One is the workshop on partnership firm taxation for section 9B and 45 subsection 4, which are newly introduced by the Finance Act 2021. It will be held on Saturday, which is the 9th of October from 1:30 p.m. And the speakers are going to be fantastically explaining with a panel discussion. You can see the details of the events on bcsonline.org. Go to the event section and enroll ASAP, because we have a plethora of applications coming in and we're looking forward to this event and your participation. Meanwhile, since the due date has been extended, you can also take the benefit of attending the tax audit workshop, which will be presented on the 24th of September. And that will be from 2 p.m. until 7 p.m. with two sessions therein where we will be discussing the audit process as well as the changes in the tax audit and the laws therein. You are most welcome to go on the website and enroll as soon as you can. Well, income tax returns are the most imaginative fiction being written today, which was said by one of the great Pulitzer Award speakers and author of United States of America. And since we have amazing speakers today, Ms. Chaitee Londhe and Mr. Nayak, who presented the changes in the law so very well, along with the amendments and the dates, and so detailed, that we are very grateful as BCS to them. Thank you very much for your time, and we appreciate the kind of presentation you could give in a very short time. Thanks again from all of us and the events team.
Thank you, everybody.
Thank you.